Boyar Research is out with its annual list of 40 stocks that they believe are positioned to outperform in the year ahead. They call it the Forgotten 40. This year's list has some repeat picks like Uber, along with some new picks like Airbnb and Berkshire Hathaway. Joining me now, Jonathan Boyar, Boyar Research president, to talk about some of these picks. Now, just a framer for folks, you're a value investor, so you're looking for stocks. When you say Forgotten 40, it's stocks that you think are good value, and maybe the time horizon I think is a little bit different than your normal methodology. So walk me through that real quick.
Yeah, absolutely. Normally we're long-term patient investors. We look at things on a 3 to 5 year basis. But for the Forgotten 40, it's a little bit different. We look at what's going to make the stock go up in the year ahead. So the list and the report is full of catalyst-driven ideas. So they're not our cheapest names, but our names that we think will outperform.
Gotcha. In that shorter term time horizon, when we're looking sort of broadly at these sort of, I guess, value stocks of any size, what are some of the macro catalysts you think in the year ahead? Because I know some of these guys have specifics, but I'm curious what your higher level thoughts are on that.
Yeah, no, we try our best to ignore the macro as best as we can, just because it's almost impossible to predict who was, Liberation Day wasn't on many people's bingo cards, so it's hard to, you really want to do the best to ignore it, but you also want to look at things like when we're talking about the Atlanta Braves holding some like tax law changes that are coming into effect in the coming years that serve as a catalyst.
Okay, so you talked about Atlanta Braves, so let's dive right in and talk about the Atlanta Braves. And this is one, for anyone who has watched Yahoo Finance and has seen your appearances before, this is one that you have liked for a long time, and you've brought it up. It hasn't done so well over the past couple of years. Yeah. So what's going to change this year for this one?
Yeah, no, it's been a disappointing pick, but I think this could be the year. There's a tax law change coming into effect starting in 2027 that basically your top 5 employees can't be deducted for income tax purposes. This puts them at a huge competitive disadvantage versus their privately.
And just sorry to interrupt. So when you say top 5 employees, you don't mean like necessarily the CEO.
Yeah.
If it's a sports team, it's the top paid employees, which in many cases, probably some of them make more than the executives at the company, right?
Exactly. So basically, they can't deduct it for income tax purposes, so their profitability goes down significantly, and they're at a huge disadvantage to the other teams, which don't face that same law. So it's Atlanta Braves Holdings, which owns the Atlanta Braves, is controlled by media mogul John Malone, and he's famous for avoiding taxes legally for any way possible. So we think this could be an impetus for him to sell the team in the coming year, as sports franchises are hot, and he might as well try and ring the cash register. He's also simplifying his empire, as you've seen with Charter, et cetera.
Right. And so it could potentially go private and wouldn't be subject then to that tax change you're talking about. One of the stocks on your list that I don't think we've talked about before, at least, I'm not as familiar with, is called Markel Group. And this is a diversified company, owns a bunch of different types of businesses. What is it about this one? Yeah,
it's a baby Berkshire. Essentially, it's run by Tom Gaynor. It has a terrific long-term record. It attracted the attention of activist JANA partners. They're doing things to help unlock value. They're essentially an insurance company. They're buying back a lot of shares. It's trading about $2,000 a share. We think it's probably worth $3,100.
Okay, gotcha. And what, again, is the catalyst here JANA? Is that they're pushing for something that's going to change operationally?
Yes, making the insurance stronger and buying back a lot of shares.
Gotcha, okay. Cooper Companies is another one, and this is a healthcare company, healthcare supplier, makes contact lenses, makes women's health products. Healthcare, a lot of investors like healthcare going into this year, although many of the folks I've talked to are talking about drug makers. But what are the catalysts going forward for this one?
Like Markel, there's actually 2 activists involved. What we think they should do is split the business in 2. They have a dominant contact lens franchise where they have 25% of the market. We think that should be split from the women's health because it really makes no sense to have them together. So we think that could be a catalyst going forward, plus better capital allocation.
Uber is one that I know that you like. The stock did well last year. So again, this is not your traditional beaten down value play that you're looking at here. But Uber, more recently has been a little bit more challenged after a surge for a lot of last year. So what's going on here? What's going to change for Uber to give it more upside this year?
Yeah, Uber was on last year's list. It was up roughly 40%, but in the last month or two, it's had about a 15% drawdown on fears of robo-taxis and autonomous driving. We think they're a beneficiary, not a victim of robo-taxis. It's buying back a ton of shares. It's growing rapidly. We think it's a great long-term hold, not only for the year ahead, but for years and years.
Now, we're not going to get through all 40, obviously, but just to take a step back here and look at the performance of these forgotten 40 versus value last year, you guys outperformed the S&P Value Index and most other value measures with that 12.7% gain. But the S&P 500 was up 14%. So I'm just, I always struggle a little bit with value. I got to be honest with you, Jonathan, especially over the past few years, because folks like you, folks who do value, have made the argument for value. But growth has outperformed. So I mean, what do I do with this as an investor?
Yeah, no, absolutely. I mean, essentially, the S&P 500 right now is a technology fund for all intents and purposes. So you're making a very large, concentrated bet. This is a good diversifier, and if some of the Mag 7 stops being so magnificent, the S&P 500 should underperform, and value is a good place to be. And last year's list pretty much outperformed every value index out there.
So people should view it sort of as a hedge. Is that how they should be thinking about it?
I think over long periods of time, value is one of the best places to be in the stock market. I don't view it as a hedge. I think investors should be wary of the risks of being in passive S&P 500 funds and think of diversifying, because, as I said earlier, it's full of technology names and is levered to 5 or 6 stocks.
That's worked out really well for them, though.
It works out well till it doesn't.